Hello, everyone, and welcome to SumZero Headlines. This is Avery Pagan. On this podcast, we showcase active investors and their best ideas, plucked straight from the SumZero community. This week, we speak with a veteran SumZero contributor, Gregg of Fortree Island Advisory, on semiconductors and wafer fabrication equipment. Even if you don't know what that is, Eric will tell you why this industry is steadily moving from growth cyclical to pure growth, how the US has cornered WFE manufacturing, and how new sources of demand, from electric vehicles to 5G, are fueling substantial upside for WFE companies. Gregg walks us through the complex semi-supply chain, which he says has become as nationally important as oil, and a few of his favorite players, including Applied Materials and Lam Research. Enjoy.
Eric, welcome to the SumZero podcast. It's awesome to have you. You've obviously been a longtime member on SumZero and have been very prolific over the years. Today, I wanted to chat with you about the semiconductor industry. This is super fascinating for me because, I'm used to hearing a lot on TV about companies like Intel and NVIDIA and Broadcom. And what you've sort of done a lot of work on that I think is really interesting is the wafer industry itself, kind of going further back into the supply chain. What do companies like Intel and Broadcom and all these other better known companies rely on in terms of how they make their chips? And so, with that, if you could maybe just quickly first tell us a little bit about yourself and your fund. Maybe we could start with that, and then we can kind of get into the WFE industry.
Great. Appreciate it. And Divya and Avery, I think it's really great, the platform that SumZero offers people like myself. In terms of Fortree Island Advisory, we're about 10 years old now. We're a real fundamental-oriented shop, and I think the area that we focus most on is expectations investing. We look for opportunities where we see a huge disconnect in what we think the market is pricing in terms of expectations for a given company and how we think they're going to perform over the next few years. We have typically very long hold times and not a lot of turnover if we can help it. And we're a concentrated strategy. WFE industry is one that we found incredibly interesting. We've been involved in now and written about on SumZero since 2016 quite a bit. But it's an area where you can be kind of agnostic as to who the winners might be in various areas of technology. At the root of all these technology trends is typically semiconductors that are allowing various things to happen. And without these WFE companies, it's a very oligopolistic, very concentrated industry, without these companies and the leadership they provide, we wouldn't be having a lot of these advances that we're having right now. They're pretty cheap, and we think there's a great outlook, especially given some of the trends that we're seeing.
Yeah, so Eric, let's start out with just explaining what the WFE industry is and what is wafer fabrication equipment, and why is it important to the semiconductor industry at large?
Yeah, the wafer fabrication equipment industry is comprised of, at the highest level, there are about 5 companies, which are the top tier companies. ASML is the largest by market cap. Applied Materials is the largest by revenues. Lam Research, KLA, Tokyo Electron, that's really the top tier. And what they do is they make machines, they make chambers effectively that take the wafer and you basically deposit and etch away materials to make structures on the wafer to turn it into a functioning chip that does what chips do. So whether it's a logic chip or a memory chip, a storage chip, a sensor. The neat thing about this industry is while most semiconductors are manufactured in Asia, the bolus of expertise in wafer fabrication equipment is actually in the US. So you have Lam Research and Applied and KLA, all US-based companies, even as ASML, one of their largest divisions that helps on their EUV, Cymer is based out of San Diego. So it's a very US-centric industry, and it's really the foundation for a lot of technology.
That's a really notable point. I think a lot of people think of the semi industry as being basically dominated by Asia. But at least for this part of it, this part of that supply chain, it sounds like the U.S. actually is the leading region, which is great to hear. And I'm sure when you think about the Biden administration's priorities and some of the ongoing trade tensions between the U.S. and Asia, this becomes kind of a nice home advantage for us in the US. So one of the things you mentioned is that the manufacturers like Intel, they actually rely on these wafer fabrication companies. You kind of described this as in your SumZero research as the picks and shovels of the semiconductor industry. Can you just dive into that a little bit deeper? Like what is it about these companies that's so unique? What makes it hard for some of the more vertically integrated companies to even replicate and reverse engineer some of this technology? And even on a more global basis, like what is it that's allowed these companies to develop in Silicon Valley and just in the US that sort of keeps this somewhat special and creates the, sort of that moat around the business that will hopefully enable them to keep growing?
Sure, that's a great question. So this, I would say, first of all, decades of expertise that have built up. If you go back 30 years ago, the US was arguably the largest semiconductor manufacturing area in the world. Over 30% of global semiconductor manufacturing in 1990 was in the US. And now it's about 12%. It's really migrated to Asia. I think this industry started here because this was where, until a few years ago, Intel was far and away the dominant, semi manufacturer in the world. And you had a lot of other companies out there, whether analog semis like Texas Instruments, which are big in the US, or Micron, which is a huge memory company based in the US. So there was a lot of stuff going on here. And I think it has a lot to do with the higher education programs we had, but this intellectual property built on itself. And a lot of it has to do with the collaborations that these companies realized they had to do very early on with their customers, and where they kept on finding new problems, solving the problems, iterating on advancing the technology. And that led to real strength in various verticals within wafer fabrication equipment. So you have companies like Lam Research, which realized half a decade ago that this keeping chips planar was going to be really difficult, and keeping on moving forward the performance dynamics on chips. So they became an expert in vertical scaling of chips. And then you have companies like KLA, which really developed a great niche in inspecting and doing metrology on chips. The more, the finer the dynamics are within these chips, the tolerances, the more you have to inspect to make sure that the way you're trying to fabricate the chip is being done appropriately. So they became very strong there. Applied Materials is strong across the board, but they're really big in materials engineering and various deposition and etch and inspection different products. So all of them develop very strong expertises in various areas, and they've been able to leverage that as these companies have grown. Their customers have to move very quickly and transition technologies very rapidly, and I think they just became this kind of symbiotic relationship.
Right. So the WFE industry, can you just size that market for us? Like, where does it stand today, and where's it going?
So global semi industry is about a $450 billion industry, going to $500 billion in 2021, according to Gartner. The WFE industry is a $60 billion industry in 2020. It was 3 or 4 years ago, it was a $35 billion industry.
Wow.
And now it's going to be $70 billion in 2021. And it could easily be $100 billion within the next few years. It's growing rapidly because these technologies keep on becoming more and more capital intensive to be able to have them deliver the performance they're delivering. And we're way under capacity right now because COVID really accelerated a lot of technology trends that the semi industry was woefully unprepared for, and there just needs to be a dramatic amount more capacity.
And let's dive into that. The demand for chips is increasing for a variety of reasons. Obviously, you have everything from Internet of Things to AI infiltrating every industry, be it the automotive industry. Can you just maybe frame or give some examples of why the growth rate in demand is not going away anytime soon? Because I think it's worth really emphasizing that this is not a short-term trend, but something that has years of runway ahead of it.
So I think one of the neatest things here is a lot of people are, if they're familiar with this area, they know about the growth in the leading edge. People focus a lot on AI chips, the things that NVIDIA or AMD are making these graphic processing chips, and they focus on what's going on with the most leading edge and robust chipsets. But one of the real under the cover stories here that's the most exciting is that it's the trailing edge chips which are even showing higher growth rates than these leading edge chips. So, and this goes back to what's happening with automobiles. So if you think about your automobile like 5 years ago or something like that, the amount of electrification of that vehicle was minor compared to the way it is now. The semiconductor content is up 150% in like literally the last 5 years. And we're going to see that only increase as we go to more electrification of the vehicles, with more sensors, with bigger dashboards, and more entertainment systems. But you also have that Marvell technology, which is a semi manufacturer, who makes ASICs for networking chips, basically, and they're the leader in that area, and they can't get enough foundry capacity to make these networking chips for the big networking product providers. Qualcomm, who their chips are in really short supply right now. One of the things that happened was that big snowstorm and cold spat that we had in Texas took out a foundry, and 30% of that foundry was dedicated to making certain chips for Qualcomm. So you're seeing all these, these growth trends. It's very typical that, semiconductors have just really grown a little bit faster than global GDP. Well, last year we saw negative GDP growth, and we saw high single-digit global semiconductor growth. And most of these companies are realizing that we have many years of well above historical growth rate in semis. And that means that there has to be an enormous amount spent on WFE to be able to facilitate that.
Sure, and I almost wonder if you just took even like one trend, autonomous driving. I mean, this is obviously, we're in very, very early innings there. The impact that's going to have on the auto industry and what that might require from a compute standpoint, just from a a computing power standpoint, that itself could be a significant contributor to demand for some of these chips that these companies make. Where would you say, from a CapEx standpoint, the industry sits right now? If we look at some of the bellwether names, where are they today versus what they're forecasting for 2021, 2022? If you can kind of give us some data points there, I think that'd be...
Yeah, no, I think, so TSM shocked everyone, including their customers. It was kind of funny on Lam Research's January earnings call. So they said they were shocked by it. They increased their CapEx forecast from $17 billion, which had been an all-time high in 2020, to $27.5 billion. It was like 60% CapEx growth in 2021. And they also, at the same time, increased their long-term revenue guidance. And if you also use what they said is their long-term kind of CapEx to sales guidance, it seems like the new level for TSM, which in the last few years, they've been kind of bouncing around 12 to 14 to 15 billion in CapEx. It seems like the new level for them is in the high 20s, and it's going to be going forward.
Wow.
You have last year, Samsung did 29 billion in CapEx. When the prior year they did, for just their chip business, when the prior year they did in the high teens. This year they're going to grow at least 10% as well. They're going to be in the 30 billion of CapEx area. And the big question mark is Intel. They have a new CEO who's a real technologist, who basically indicated on their Q4 earnings call that he wants to bring Intel back to its former glory. And there are high expectations. They're supposed to be announcing something in the next few weeks in terms of their technology roadmaps. It's very possible that they're going to announce a huge increase in their CapEx, because they've been relatively underinvesting compared to their biggest competitors, being Samsung and TSM.
And on top of that, you have the Biden administration. They obviously, and I think America as a whole has a national interest here. What's the degree to which they're considering subsidies for the industry?
Yeah, this has become the new oil, if you will, where there's a increasing view around the world where various regions and countries have a security interest. It's a national priority to be able to have a strong semiconductor infrastructure. So to answer that question directly for the US, a year ago, there was a bipartisan bill put out that kind of got caught up in the election paralysis called the Chips for America Act. At the time, it was talking about a $25 million subsidy to support for the chip industry. And that's now grown to discussions around $37 million. And there's been speculation that by the time we're done, that'll be a $50 billion spend on bolstering U.S. semiconductor manufacturing capabilities, particularly at the leading edge. There have been lobbying by lots of U.S. major semiconductor manufacturers behind this. But it's not just in the U.S. In Europe, they just this month announced what they're calling their digital compass. They want to have 20% of the global semiconductor capacity be made in Europe. Right now, that's in the single digits. So that would be a huge increase in terms of European semiconductor manufacturing capacity. And the biggest one in this area, well, most people don't appreciate, most semiconductors are, the two biggest areas right now are Taiwan and South Korea. China has been making a huge effort in this area, and they've been spending tons of money on it. And they spent at least $50 billion over the last number of years to subsidize their chip industry. It's clear that they're going to spend that much or more over the next number of years to be able to support the industry, because they have a goal of being able to be self-sufficient for 40% of their semiconductors.
Right. I mean, this sounds almost like the war for 5G dominance, except it's not really making much headlines. Like I don't think the average person is really talking about this, but it seems like maybe at least amongst the industry pros and maybe within the government, there's much more of a dialogue going where they do understand that, like, hey, this is of strategic interest, which I think is great. One of the other elements of the semi industry, which I think has maybe weighed down on the WFE industry, is this notion of cyclicality, that the semis are known to be a little bit boom and bust, just very volatile in terms of their revenues and cash flows. How are wafer fabrication equipment, or how is that industry different from your typical semi manufacturer?
So I think the epitome of that volatility has historically been the memory semiconductor industry,
right,
where they go through what seems like 7 quarters of a down cycle, where margins get compressed dramatically, and then they go through these scorching up cycles that last 6 or 7 quarters. And if you time that right, it works out really well. With the WFE companies, honestly, this has been for the last half decade an up and to the right industry. And there have been times where there have been some lulls, but there has not been a huge amount of, typically it's almost like you're going up this mountain range and you hit a plateau for a little while and then you scoot higher. And it seems like we are just, at base camp, and we have a long way to go up the rest of this mountain. So,
right.
And in terms of the free cash flow characteristics, like, you have especially the memory companies, but you're seeing now with all the logic guys, they'll be spending 30+% of their revenues on CAPX. The WFE companies spend 3% of their revenues on CAPX, 4% of their revenues on CAPX. They have 30+% operating margins. They outsource. They get a lot of other people to make subsystems for them. They assemble them. They put a lot into R&D, but there's not a lot of CAPX. So the free cash flow characteristics are extremely robust for this industry. And because they've been limited in the amount of consolidation that they can do, because everyone knows how much of an oligopoly it is, and regulators have stopped at this juncture, like large-scale M&A, they're having to spend most of that buying back stock and dividends for shareholders. So it's a very shareholder-friendly industry.
And how significant is the maintenance aspect of their revenue stream? Once they sell the picks and shovels to the manufacturer.
And I think this is one of the most understood stories out there. So even though they sell capital equipment, it's basically they're selling a subscription every time they go sell a device. These machines are effectively chambers that do things in them, and those chambers are an annuity stream for the next 10, 20 plus years. And the biggest WFE companies have over a third of their revenues are coming from just spare parts and service agreements.
Right.
And then, what happens with these companies, which is very kind of subscription-like, They get their tools qualified. Once they're qualified with a customer, that becomes the preferred tool of record. And anytime that customer is expanding in that area, they just keep on ordering those tools. They don't have to, they've already agreed on the pricing. They qualified the whole thing. So these guys basically have very entrenched positions at their customers, and it's very subscription-like business.
What's the typical maintenance contract look like? Do they have a, would a 10-year maintenance contract be typical?
No, I don't think it'd be multi-year, and all of them have been moving more to these multi-year contracts. But one of the things they've done to make it so attractive to these semi manufacturers is they'll guarantee certain levels of uptime as long as these contracts are signed. And it is almost always these companies who buy the equipment from the Applieds and Lams of this world, they need to sign up with Applied and Lam to service their machines, because they won't warrant their machines. They won't warranty the machines if they don't.
Right. I mean, this almost sounds like an HVAC contract that you might have with your.
It's a great example.
Right. Exactly. That's really interesting, and also you mentioned that around a third of revenues are coming from agreements.
Yes.
Wow.
That goes up every year regardless, as long as there's high usage and high throughput on those machines. You're going to just see those news. No matter what happens, those revenues keep on going up.
Right, and you mentioned that these agreements are essentially subscriptions. In terms of their nature and probably also in terms of their cash flow characteristics. I mean, I'm assuming you agree, and you've pretty much said this in your analysis, that as a result, like, they should warrant or justify significantly higher multiples than they're getting in the markets today. Can you just maybe tell us what you think these companies deserve from an earnings multiple standpoint, given the nature of their business and stability of their cash flows?
Sure. I mean, so one of the most recent things I wrote on SumZero is about how these are Rule of 40 companies, and I think there's going to be an increasing recognition that they are. And if you look historically over the last 5 years, or even look in the projections, they are very strong Rule of 40 companies. And Rule of 40, for those who are a little less familiar with it, is you take the growth rate, add to it the margins, usually is EBITDA margins, and if those two things together are above 40, you have a Rule of 40 company. And typically Rule of 40 companies are very well valued in the marketplace once the market really realizes that this is a sustainable Rule of 40 company, especially if they have robust growth rates. And I think if you look at these companies, right now they're trading at less than, let's take an Applied or a Lam Research. Each of those companies trade at, say, less than 6 times revenues. The top SaaS Rule of 40 companies are trading at close to 30 times revenues. If you look at it on a PE basis, on calendar 2021, take Applied or Lam, they both trade at, let's say, the high teens times consensus. And if you really, the consensus right now is too conservative. I think it's even more mid to high teens types of EPS multiples. The market trades at 24 times. These guys are growing at least 2x the market. If not more. I mean, they're growing over double digit on the top line and maybe 20+% on the bottom line. So I think these guys deserve to be trading at a significant premium to the market, let's say 30 times earnings. So I look at a number of the ones that we're invested in, and we're very heavily invested in the sector at doubles over the next 2 to 3 years.
So let's go through some of these on a more case-by-case basis. Let's maybe start with the bigger guys, and then we can move on to some of the smaller up-and-comers. But what are your favorite names amongst the larger cap wafer companies?
Sure. So the two biggest top-tier kind of semi-cap equipment companies that we like are Applied Materials and Lam Research. Both of them, as I indicated, are trading, let's say, mid to high teens times forward earnings. We look at Applied should be doing over $8 in calendar 2023 earnings. I think Lam could be doing easily $40 in 2023 calendar earnings. If you put a multiple of 30 times that for each of those companies, you get 240 for Applied. It's trading at like 115 or something today. If you do that for Lam, that's $1,200 a share. It's trading at around $550 today. So I think they're both a ton of upside there. And the beauty about Lam, it's a real play on the vertical scaling, and that's happening not just in memory now, but it's also happening in logic. And they have a really awesome management team. The CEO is a Caltech guy who was a COO. He has been a visionary in the industry, and they're very good on that recurring revenue-based business, their service spares business.
And on the vertical stacking, I don't know if everyone would know what that is. Can you just explain what that means?
Sure. So a number of years ago, it used to be that in NAND, which is semiconductor storage, that you just basically had a planar chip that was you didn't have had basically all the cells on a single layer, and now we're up to 176 layers of cells stacked on top of each other, and that's increased obviously the amount of capacity on those storage chips just exponentially. And there have been some other technology trends that have helped there too. But when they do that, there are a whole bunch of new pressures and tensions on the chip, which have created the need for whole new tools that weren't even necessary when these chips were planar. So Lam is a real lock and strength in that area. Applied has been incredible, basically across the curve. They're the most diversified company out there. They've really made some special inroads in advanced packaging, which is one of the best ways that these companies have been using to approach Moore's Law. But they've also done remarkable things in their inspection and metrology area, and they've always been incredibly strong in certain areas of deposition and etch, which are incredible areas for growth in terms of how you're building these chips. Especially, they're doing a lot of neat stuff with older nodes, and they're helping out a lot of other people. So both those companies are really well positioned.
The verticalization of the chip structure itself is essentially become a solution to some of the limits that they're seeing in terms of transistor width. Obviously, the transistor can only get so narrow. I think you had mentioned that they're reaching a threshold there.
Yeah, they're down, especially on NAND. They actually found that when these storage cells got too small, the information started bleeding from one cell to another. So getting smaller wasn't helping. They needed to go vertical to add more cells onto the chip effectively. And then on the logic side, they keep on trying to get these nanometers down to, they're at 5 right now. TSM is going to be at 3 within about a year. And human hair is about 80,000 nanometers. So we're talking about the size of the width of these transistors is so small you couldn't see these with a normal microscope.
Incredible. So Lam and Applied are kind of two of your favorite amongst the large caps. I think I was checking earlier. They're both north of 80 billion market cap. What are some of the smaller ones that you like that you think are also innovative and could potentially see potentially a higher return?
So I'll give you. I'll put them in two groups. One, I would put Kulicke and Soffa and onto innovation. Kulicke is a really neat value play, and they've really changed their stripes over the number of years. But they're an advanced packaging company, and they also have a really neat business in micro mini LEDs, which is basically doubling every year. And the advanced packaging business is so strong right now, and this is the way to connect a whole bunch of chips together to make them more efficient and powerful. It's so strong that they basically said they're basically sold out of capacity through early 2022. They're probably going to do about $1 a share in earnings this quarter. That's $4. They have about $9 in cash by the end of the year per share on the balance sheet, no debt. So you could get them basically ex debt or ex cash, for about 10 times earnings, which is not a multiple any of these companies should be trading at. I think that could easily double. Onto Innovation has two main businesses. They're big in inspection and metrology, which is incredibly important at the leading edge. And they're also really big in this advanced packaging as well. And I think we'll be doing $5 a share probably by 2023 in terms of run rate earnings. Put a 25 to 30 times multiple on that. That's 125 to 150 a share. They're currently trading in the mid to high 60s per share. So I think there's just a ton of upside there. And the other thing about them is they trade at, let's say, 20 times near terms earnings. And their peers all trade at kind of 30 or above. So it doesn't make a lot of sense why they're so cheap.
Very interesting. Lastly, let's just talk about catalysts. If you can maybe provide a roadmap for the near term, maybe 6 to 12 month period on what's kind of to be expected that could help move these stocks upwards.
Great. I think I'll be even shorter term catalysts here. Intel, as I alluded to, checking with the company, the expectations in the next few weeks, we're going to have its newly seated CEO who's just returned back to the company from VMware and EMC. And I think there's a real high chance that he's going to recommit to their long-term manufacturing base. And if that's true, they might parallel path where they're going to obviously need to outsource in the short term. But if they're going to really refocus on gaining technology leadership, the amount of CapEx they're going to have to spend is enormous, and that will be very positive for the WFE companies. Additionally, Applied Materials has an analyst day on April 6th. They already, at the Morgan Stanley conference, alluded to some of the aspects of how robust they think the future may be. I think they're going to really define that in a much more clear way. And I think the market will probably start getting very bullish about these stocks leading up to that day. They also will probably announce a huge stock repurchase program. They have a deal that either is going to get approved by the Chinese regulator this week for a small acquisition, or it's going to get killed. I think most people think it's not going to get approved by the Chinese regulator in time, and that's going to leave them with enormous amount of cash to buy back stock, and that's going to be very positive. And then we're going to get to earnings here in April, and we'll have ASML and Lam and KLA coming out relatively early. And all these companies were Morgan Stanley a couple weeks ago, and they basically were saying how things are even better, a month after they've done their last earnings report than they expected they would be. UBS is out this morning saying that TSM, they're seeing channel checks that TSM is pulling in orders and ramping up orders much faster than a lot of people expected. So I think we're going to see a lot of increased guidance both for Q2 as well as for 2021. I also think we're going to have a lot of analysts or investor days over the course of the year that are going to help people really understand how robust the medium-term outlook is for these companies.
Right, and from a reopened trade standpoint, do you see these companies benefiting from that, or is it sort of an irrelevant background noise?
Yeah, I think that some of these stocks some of them are 5 to 10% off their recent highs. And I think some of that came because they got caught up in some of this high beta tech sell-off that was happening due to the interest rate increases that were going on out there. But I think these are fundamentally a different situation because the valuations here are very different from, let's say, the SaaS stocks that are, have a lot more of a valuation challenge with higher discount rates.
Datadog and Snowflake.
Say what?
Datadog and Snowflake.
Yes, that's exactly. So I don't think we have that problem, and I think here this great acceleration that McKinsey has termed, I think these accelerating technology trends, I don't see how that's going to go away. I also don't see how it's going to go away that all these countries are more interested in having, they don't want to have $50,000 cars and production lines for those vehicles being held up because we can't make semiconductors that cost $1. So I think there's going to be a lot of money that's going to be spent on these WFE companies for years to come. And I think that's going to be really positive.
Eric, I think that's a great way to end the segment. Thanks again for providing all this insight. It's always great to hear about new innovations, and I think this is an industry that's maybe been a little bit under the radar for whatever reason. Maybe these companies need to do a little bit more marketing on mainstream media. But thanks again, and we'll certainly follow up and track these companies over the coming months and years. And I think for all of us, we hope that a lot of this growth comes to fruition. It's part and parcel of I think a new world. So thanks again for joining us, and hope to stay in touch.
Thanks for the opportunity.
Thank you for listening. That is all we have for you today. If you'd like to read Eric's original research on Lam, Applied Materials, or Micron for that matter, you can find those pieces on SumZero. You can also find the Fortree Island Advisory fund profile on the Cap Intro platform. We are thrilled to continue bringing you the top managers, insights, and ideas from our community, and we strongly believe in sharing well-researched, quality investment information with the masses. That is why SumZero, which has historically been a buy-side only community, has begun to open up access points for individual investors. If you'd like to learn more about those options, please reach out to the SumZero team and have a great rest of your day.